Welcome to Nick Speaks, everyone. This is a show where you'll get a completely unbiased opinion on potential investment opportunities from condos to single-family houses and multifamily properties in Chicago and the surrounding suburbs. If you like the content, please share, like, and subscribe. Thank you, everyone, and enjoy the show. Mr. William Burns.
What's up, Nick?
How are you, brother?
I'm doing good, brother. Thanks for having me.
Absolutely, man. My pleasure. All right, so we have about 15 minutes for us to talk a little bit of shit.
Let's do this. I got 15 minutes for you.
All right, perfect. The reason I'm bringing you here is because I've been having some not difficult clients, but maybe clients who are with a little bit more interesting type of financing they're purchasing right now. So
Outside the box sort of stuff.
A little bit outside the box, yeah. I mean, again, nothing crazy.
Okay.
No drug money.
That's
good.
We don't want
we're not
drug
laundering money, so that's good.
No, it's all got to be legit.
Yeah. So, very first thing, I have a few questions for you, basically.
Okay.
I prepared a couple of questions. The very first question is we're going to start with a curveball, is like, how the fuck lenders make money? Explain it. Explain to people, because I've been asked this, and I'm trying to explain to people. Be like, listen, there's margins there. The bank borrows money, and then for a certain interest rate, and then they lend you the money on a little bit of higher interest rate. That's how they make money.
That's exactly how it works.
But explain it a little bit more of a detail without going into an essay there with this kind of explanations.
The way that it works is on any given day, you're going to get X interest rate is being offered, right? So if that rate's being offered, the bank is making a margin off of that interest rate, which is
let's talk number. Let's talk hypothetical
paid.
numbers. So let's say today's rate is like, what do you borrow on? Like, let's say 4%.
Okay.
Hypothetically, right?
Okay.
So then you take that 4%, and then you go to Johnny who wants to buy a house. You're like, Johnny, we got a mortgage for you, buddy. You're borrowing $500,000. Your rate is going to be 6.5%.
Yeah. That's exactly what it's probably going to be today.
6.5%.
Yeah.
Right. Good. So basically, that's how you guys make money.
Yeah. It's exactly it. So every interest rate is going to have there's a margin that's associated with it that money goes to the bank.
Okay.
So when borrowers are out shopping for mortgages, I suggest every client shops for mortgages. I know that you suggested too to always talk with multiple lenders, which I am open to that as a lender, because I know what we offer is a very competitive product. And the reason that it's competitive is because on any given day, that interest rate is going to be making a different margin. We're able to go thin on our loans because we're not looking to make a ton of money off of just one transaction. We want repeat clients. We want those clients to come back to us. So that's how we're able to offer lower terms than some of our competitors are. But yes, margins is exactly how banks make money.
Okay. Yeah. Like I said, clients are basically, it came up a couple of times.
How lenders get paid comes up?
How lenders get paid, basically.
It's a great question.
Because, they want to be involved in the process, and I don't want to lie to people. And I basically explain them the exact same thing. Be like, listen, the bank borrows money, and then they borrow you on a...
Well, what I like up front
that's it.
is with the client, if you have we like to have an in-depth conversation with the client up front. That what we do is we go over what the terms are at that current moment. Let them know that we'll lock in the terms once they get under contract. And then we also go over the closing costs. So I will actually send out a loan estimate, which is the official disclosure form up front to let clients know what they're actually getting into. A lot of places don't disclose it up front. They wait until the person's under contract and they kind of have them handcuffed, if you will, to get them in without being fully transparent with the fees and the costs associated with getting a mortgage. So I send that out up front early so that clients are comfortable with the transaction. Okay.
So, for example, I've been noticing in the past few months, I'm kind of like, in general, I try to keep a close eye on when my clients get those closing documents.
Yep.
And I'm looking at the fees that lenders charge. Explain those fees. Like, what are the very basics, like the very basics of those?
Yeah, so you're going to have a lender fee, which our lender fee is $16.95. Okay. That lender fee goes towards covering the underwriting of the loan, the processing of the loan, like basically the pushing of the paper is what that fee covers. You have your appraisal fee, which that appraisal fee is typically anywhere from $600 to $700. Okay. That appraisal fee covers the appraisal. So that's an upfront cost.
Okay.
And then you're going to have your title costs. Your title costs vary. So like you've seen that before. Title costs in the city can range anywhere from, I've seen $3,400 up to $4,400.
Correct.
So we disclose all of that up front where there's no surprises at the closing table.
Okay.
And then that way the client's comfortable with submitting their documentation. The client's not calling up with concerns 2 days before closing that you've probably experienced before.
Yeah. Yeah, they get the final CD and be like,
What's all this
fuck?
expenses? Exactly.
Correct,
What
yeah.
what am I paying for here? Why?
And people don't understand. I mean, unfortunately, state of Illinois and specifically the city of Chicago has a lot of, I call them bullshit fees.
The transfer taxes are a big one.
Transfer tax.
$7.50 per every thousand. Yeah.
It's fucking stupid. What was the other one? Yeah, transfer stamps, like whatever it is. Like in general, they have like so many bullshit fees that clients are like, at some point when they get to the final of they're basically on the finish line, and they're like, okay, we're almost done, and then they see that extra $3,000-$4,000.
Yes, they
they're
do.
like, there's nothing we can do about it at this point. Fuck it.
That's why we do it during the
is.
pre-approval process, so that clients know exactly what they're getting into.
Yeah, and this is something that comes up more often than not by people. Is like, okay, why am I paying all this stuff? And I'm like, listen, because there is no explanation why you're paying this, because you have to pay it. The reason for that is because like it is what it is.
It's part of the process. There's a lot of hands involved in the transaction that all need to get compensated.
Correct.
For
the city of Chicago needs their money. That's why.
Yeah.
That's literally why it is. And unfortunately, but that's why I wanted to bring you up and answer some of those questions. Is like to break down those fees. Correct.
Yeah.
So now, a lot of people. A lot of the buyers are getting smarter and smarter out there, and they're getting more sophisticated in terms of shopping lenders.
Which is good.
And then a lot of the people are starting to see more and more, for example, the lender covers appraisal.
Yeah.
The lender covers free refinancing.
There's a commercial out there that goes, when banks compete, you win.
Yeah.
Let us compete for your business.
Yeah. Which, again, what do you think is reasonable for... Again, I know that this is probably you shooting yourself in the foot saying things like this, but
You're really setting me up, man.
I know, right? But what is reasonable for a client, a buyer, hypothetical, to ask for a lender to cover when? Again, we're not talking about FHA 3.5% down, $250,000 condo. We're talking about $750,000, 30% down, very motivated buyer, and he or she's talking to 3 lenders. What is reasonable for that person to ask a lender to cover besides the rate? Like the rate is one of the most important things that is very competitive.
Yeah.
What is another thing that you guys will be willing to compete with? And again,
so
I completely understand.
It depends on the borrower.
To you.
No, I'm totally fine with this question. It's really going to depend on the borrower.
Okay.
Because some borrowers are going to be just rate driven. So for rate driven, then we can get competitive and drive that rate down. Other borrowers know that interest rates are on the higher end right now compared to where they were years ago when they were in the 3s, to where people are, really, really rate driven and sensitive to keep it lower. But then you got those other clients that are like, hey, I want to keep money up front. I know that rates are high. I'm going to refinance soon. So they'll take that interest rate, but then they want money to go towards the appraisal fee is very common to get waived. I've waived lender fees for certain transactions. So like you have to do your due diligence and shop the market. I would always suggest you have 2 to 3 that you're working with, because on any day, the interest rates are going to change. To go back to what we began with, the margins, that margin in there, I can take the additional from that margin and apply that towards the appraisal. So that's how banks do that.
Okay.
That's exactly how banks do that. So they're taking money off of their compensation to cover an expense for the client is what's happening.
Okay.
Yeah.
Got
But
it.
when it's a competitive market, that's absolutely the things you should be asking for.
Okay. So basically, appraisal fee can be waived. One thing.
It can be.
It
Where
can
we
be. I
get
mean,
the appraisal
of course,
waiver.
I'm not saying
It's not
that
one
every
size
person-
fits all. Yeah.
Exactly. I'm not saying every person will do that, but let's say appraisal fee can be waived. Free refinancing might be involved. Explain to me. There's another question I have to you about floating rates. So, for example, I don't want to shit on any lender. I'm just giving an example. Let's say Chase, hypothetically. Chase are a good bank. And when they're locking someone's rate, let's say my client wants to go with Chase, and they're like, hey, no problem. The rates today are 6.5, hypothetically. And we're locking you at 6.5 today, April 7th. Let's say rates drop down by 25 basis points. They're 6.25 in 6 days.
Yeah.
They can relock you for free once.
Yeah. Most banks are once.
Once.
Yeah. Most banks are once.
Let's say hypothetical scenario again, in a perfect world, that in 2 weeks, let's say the loan is closing May 15th. In two extra weeks, the rates are down to 6. What's happening then?
Yeah, so typically the way that it works out, just because you got documentation that has to get to the closing table and be accurate, is that the float down, we typically suggest, like, you can do it up to 3 days before closing, but then you could be scrambling to get the documents right.
Okay.
So we typically suggest at least a week out from closing is when we want to look to float interest rates down. We have a float down policy that's absolutely free. So if we do lock in your interest rate as soon as you get under contract to ensure that there's no exposure to it going higher. Mm-hmm. But if the rates go lower, we can float down that interest rate at no cost.
How many times?
We can do it multiple times.
Okay. Why? Why you can do it multiple times, but 95% of the other lenders out there cannot do it?
Because of our structure, the way that we're designed. You know, it's just Kyle Ernst, our owner, was really smart when he set up Stonehaven to be small and nimble, that we can move with the market.
Okay.
So because of our size, we're able to be flexible with terms and be able to get what the clients want in the market.
Got it. Okay. Another question. Underwriters are probably the biggest pain in the ass in the world in general, like in the real estate world, right? This is your mortal enemy. Like, I fucking hate them all.
I love my underwriters.
Again, I fucking hate them all because, they tend to screw up with closings and etc.
Yeah.
They're being pain in the ass about asking. And again, I'm sure if you're out there and you're underwriter, you're probably a good person. You're just like the people who write tickets, right? You got to do your job. Yes, I get it. But again, I fucking hate you all because you're screwing with my clients and you're asking way too much documentation. Now, explain, and I tell that to every single one of my buyers specifically. It's like, listen, basically the lender's job is to make you look as good as possible on paper in front of the underwriters.
Correct.
You as a lender, you are the missing link between closing and the clients, and that's the underwriters right there. You need to present them to the underwriters that they're the best possible buyers ever. But then sometimes underwriters are being underwriters, and they ask for dental records for some fucking reason. I don't know, give me the size of your underwear, give me your
feels
dental
like that
and
sometimes.
Ancestry 21. I want to see like what your grandfather looked like.
Yeah.
Like dumb shit. So why do some lenders have easier way with underwriters and other lenders, specifically bigger lenders, because I'm assuming they're more of a huge behemoth entity, Why do smaller lenders have easier with underwriters and bigger lenders don't?
So because Fannie Mae and Freddie Mac govern all lenders. Fannie Mae and Freddie Mac set forth the guidelines that all lenders must follow. Mm-hmm. And then once you start getting into different structures of banks without naming names, so a lot of it is due to size, potentially, that just their exposure in the market with the loans, that they apply additional overlays to the guidelines. And so the reason they do that is they want their paper to be A++, so that they can then sell those mortgages off in the secondary market.
Welcome to 2008, basically.
So they want to have... They put additional guidelines on top of what Fannie Mae and Freddie Mac are offering for their appetite in the market. Okay. Do you follow that?
Yep.
Okay. So with us, we go direct with Fannie and Freddie, which means we get to follow those guidelines, how they're written.
Okay.
So that's just the difference. We don't have overlays put on it. Like, now we do work with a few investors that we broker loans to that have overlays. That's on us as the lender to know what those overlays are and to accurately describe that to the clients of what they're getting into and what documentation is needed up front, so that there's no surprises, like you mentioned.
Okay. It's good enough. Difference between jumbo loan and just a conventional.
So it's based off the loan amount. So it's 626, I want to say. Off the top of my head, I'm not sitting in front of it right now. But basically, a conventional jumbo loans are going to follow conventional guidelines, but they also have those additional overlays on top of it.
Okay.
So you definitely, like, 2 years worth of tax returns are being collected, things along those lines. So they just do a little bit more due diligence on the jumbo loans because of the amount of money that's being lent.
Okay. Yeah. And the money come from the same place or different?
Yeah, they come from the same
place.
Yeah.
Okay. Let's see. I had one more question for you.
Another curveball?
Nah, that's an easy one though. If you had to buy a house right now, let's say budget $700,000, good credit, 25% down, ARM or conventional?
I'm going conventional.
Okay.
Just because right now the conventional rates are in line with the ARM rates, that I don't like the exposure to them adjusting. Okay. Now, on Friday, today's April 7th, so on the 4th, ARMs started pricing out more aggressively again, that I could see ARMs starting to come back into play really soon, actually.
Okay.
Which, if that's the case, if you're looking at staying in if you feel you're only going to be in your property for 5 to 7 years, take the lower interest rate. You can also, in the market, you can always refinance. So if your ARMs come and due, you can refinance into a 30-year product. A lot of people think that if you get into an ARM, you have to stay in that ARM or refinance to another ARM. You can refinance out of that ARM at any point to go into a fixed product.
Okay. And for example, let's say you buy ARM, you don't refinance in 5 years. You buy with a 5-year ARM, and for people, ARM adjustable mortgage rate basically. So for let's say you buy 5-year ARM, you don't refinance in 5 years. So what is the next step? Like
depends on what the market is doing. So if rates are coming down and you're in an ARM and your ARM adjusts, you'll see that ARM rate adjust downward. If rates are moving higher,
how long does it adjust for?
A year.
A year.
Yeah,
So you
some
go
are 6
year
months,
by
some are a
year.
year. Depends, because you got 6 month SOFRs out there. That every ARM is going to come with a different set of terms.
Okay.
So it's going to be up to the lender to let that client know which specific ARM product they're in, so they know when it can adjust for the first time.
Okay.
There is a floor and a ceiling to what those rates can adjust to as well. So it's up to the loan officer to accurately describe that to the clients to make sure they're comfortable with it.
Okay.
ARMs are really popular in the city because of how often clients move from property to property. Once you start getting out more in the burbs more, I don't know why, but it's just people stay longer. I start to see more conventional fixed products.
Thank you so much, man.
My pleasure, brother. Thanks for having me.
Appreciate it.
Yeah, dude. That was easy.